Hello students, welcome to my channel again. Today I'm going to talk about a very important topic of financial management, another interesting topic, theory and practical based chapter. The chapter name is called Working Capital Management. What is working capital management? Every firm should hold certain amount of investment in current assets. These current assets includes cash and marketable securities, account receivables, inventories, etc. And they are collectively called working capital management. It is associated with the proper management of investment in current assets and their financing. There are two types of working capital. The first one is permanent. What is permanent? Permanent is a minimum level of current assets that a firm must maintain at all the time. And seasonal. Seasonal is the amount of current assets that varies with the seasonal requirements. I will give you one. I will make you one diagram here. Working capital management, y-axis, and x-axis is the time. This is known as permanent working capital, and this is known as seasonal working capital. The permanent working capital is constant throughout the time, but the seasonal working capital is going up and down depending. So, what factors affecting size of the working capital? First, the nature and size of the company. Second is conversion cycle. Third, seasonal fluctuation. Fourth, production policy. Fifth, credit policy, terms of the purchase. Seventh, growth and expansion, and the significance of working capital. It is a significant part of total assets, and it always maintaining a desired scale of operation, maintaining regular cash flow and survival of the firm. Now let's have a look the cash conversion cycle. The firm duration needed to convert raw material into finished goods and then realize cash by selling them is called operating cycle or working capital cycle. To clarify this example, I'll make another diagram. Cash purchase of inventory in work in progress inventory, and this inventory is again converted into finished goods. Then finished goods is sold as credit receivables, and that receivables is collected as cash. Now let's have a look some practical example. I start from formulas. Formula is operating cycle. Operating cycle is equal to ICP plus RCP. That is, ICP is equal to inventory conversion period, and RCP is receivable conversion period. So inventory conversion period is length of time required to convert raw material into finished good. The formula is ICP is equal to inventory divided by cost of goods sold per day, or days in a year divided by inventory turnover, or inventory multiplied by days in a year divided by cost of goods sold or sales. Then let's have a look the RCP, average collection period cash. So formula wise we can write average receivable divided by credit sales per day, days in a year divided by receivable turnover, or receivable multiplied by days in a year divided by annual credit sale. Now let's have a look another. PDP is equal to payable deferral period. What is payable deferral period? Average length of period for the payment of purchase and accruals. Formula: average payable divided by cost of goods sold per day. Cash conversion cycle. What is cash conversion cycle? How do you find out that one? Conversion cycle is equal to operating cycle minus payable deferral period. Payable deferral period. CCC is equal to ICP plus RCP minus PDP, which is working capital cost of goods sold multiplied cash conversion cycle. MK Corporation has annual sales by 10 million and its cost of goods sold is 75%. Average age of inventory is 60 days, average collection period is 40 days, and average payment period is 35 days. Assume there are 365 days in a year. So required, what is cash conversion cycle? Second, amount of working capital, and third, working capital if average collection is reduced by 10 days. Cash conversion cycle, which is CCP. We know the formula. CCC is equal to, what's the formula? ICP plus RCP minus PDP. So inventory conversion cycle is, we know that average collection inventory is 60 days. Receivable conversion period is, average collection period is 40 days. Then payable deferral period is the average payment period 35 days. So 35 days. And we finally find $60, $40, $100 minus 35 is 65 days. 65 days is our cash conversion days. Now, working capital. We know the formula here. Cost of goods sold per day. Cost of goods sold per day multiplied by cash conversion cycle. What is the cost of goods sold? Which is the 75% of 10 million. That means 7.5 million. This is a year, so let's make it per day. Let's divide by 365 and multiply by the cash conversion cycle, which is 65 days. We get here working capital of $13 $1,335,616. Cash conversion cycle is 65 minus 10, which is 55 days. So new working capital would be 7.5 million divided by 365 and multiply by is 1130137. Look, the inventory management. What is inventory management? Inventory generally refers to the stock of goods that a firm manufactures for sale and components that make up the goods. Inventory management is concerned with the maintaining optimum investment in quantity and applying effective control system so as to minimize the total inventory cost. So there are some formula. Basic inventory cost. The first one is carrying cost. What is carrying cost and how do you calculate? It is the variable cost per holding an item of inventory in stock for a specified time period. Formula is total carrying cost TCC is equal to C is equal to average inventory, where average inventory is equal to opening plus closing inventory divided by 2, or C is equal to percentage of C and P, that is carrying cost per unit is calculated is percentage carrying cost C multiply by price per unit. Safety stock, average inventory when safety stock exists is equal to Q divided by safety stock. And another second is ordering cost. O multiplied by N or R divided by Q, required cost, total required quantity. Q is ordering size. O is equal to ordering cost per order. So in this way, thirdly we have got here inventory cost is equal to total ordering cost plus total carrying cost. Total inventory cost is equal to O multiplied by R divided by Q plus C multiplied by Q divided by 2. Let's have a look at another concept. The concept is the economic order quantity or EOQ. What is EOQ? It is an optimal order size of inventory at which level inventory cost is the minimum. And it enables firms to determine the order quantity of inventory at which the total of ordering cost and carrying cost is the minimum. So formula is EOQ is equal to root square 2 multiplied by R multiplied by O divided by C, where R is equal to annual requirement, O is equal to ordering cost, and C is equal to carrying cost. Finally, let's have a look at the reorder point. Average lead time multiplied by average usage, reorder point and safety stock or level. Then we got here reorder point is equal to average lead multiplied by average usage plus safety stock. Discount total inventory cost is TCC plus TOC minus discount on purchase, where TCC is equal to total carrying cost and TOC is equal to total ordering cost. Students, now let's have a look one practical example here. The question is, AJ Bell Co. uses 60,000 liters of pigment per year. The cost of ordering pigment is $30 per order, and cost of carrying the pigment in inventory is $1 per liter per year. Company uses pigment at the constant rate every year throughout the year and maintains a safety stock of 2,000 liters. Assume there are 365 days in a year and it takes 45 days to receive an order once it has been placed. So required EOQ, total cost of inventory, average inventory level, max level of inventory, and reorder level. We are given here annual requirement R is equal to 60,000 liters. Ordering cost per order is, we know that, $300. Carrying cost per liter per year is $1. Safety stock, we are given 2,000 liter, and lead time is equal to 45 days. Now let's solve the question one by one. Question 1, it is asking EOQ. We know that formula 2ROC. We know the R is equal to annual requirement, which is 60,000 liter. Ordering cost is $300 per order, and divide by carrying cost is $1. In this way we get the final value is 6,000 liter as EOQ. So in question 2, it is asking the total cost of inventory. The total cost is ordering cost plus total carrying cost. How do we find out the ordering cost? Ordering cost is order divided by multiply by annual requirement divided by EOQ plus C multiplied by EOQ divided by 2. Let's put all the value here. The ordering cost, we know that is $300. R is the annual requirement, which is 60,000. EOQ we just calculated here, 6,000, plus carrying cost is $1. EOQ is again 6,000 and 2. We get here is 10 is 3,000 plus we get here 6,000 liter is total cost. So max level of inventory in third is asking average inventory level. Formula is EOQ divided by 2 plus safety stock. We know that EOQ we just calculated earlier is again 6000 liter divided by 2, and safety stock is, we know that 2000 liter. It's just given here 2000 liters. In this way, total is 3000 plus 2000 is equal to 5000 liter as an average inventory level. Fourth, asking maximum level of inventory. Level of inventory, EOQ plus safety stock level. We know that EOQ is 6000 liter, and safety stock is 2000 liter. In this way, total is 8000 liter. So lastly, it is asking us reorder level. The formula for reorder level is average usage multiplied by lead time plus safety stock, and in this case goods in transit. The average usage is, we know that annual usage is 60,000, then we divide by 365, then lead time is 45 days. We know that 45 days is given here. This 45 days lead year, and there is a 365 days in a year. Safety stock, we know that it is given here again 2000 liter, and good in transit in this case is 6000. So if we calculate, we get here 7500 plus 2000 minus 6000. In this way we get 3500 liters of reorder level. So just to clarify here, how did we get the good in transit? I will make a judgment here. The judgment is, note that there is a build up in good in transits inventory, since lead time consumption is 7500, which is higher than EOQ, that is 6000. To satisfy the lead time order, the company has to place two orders of 6000 liters each. Of the two orders, the first order arrives in lead time of 45 days, and the second order of 6000 liters remains in transition. So the good in transition is 6000. Now let's have a look at another unit that is called cash management. What is cash management? It is the process of efficient collections and disbursement of cash, investing the surplus cash in marketable securities, and managing the funds to meet the cash deficit, and determinations and maintenance of optimal level of cash. It comprises the collections and disbursement of cash, investment of surplus cash, and financing the deficit cash, and determinations and maintenance of optimal cash level. So significance. What is significance of cash management? The first one is management of cash flow. Efficient cash flow management can speed up the collections of cash by using various techniques. Speeding up collections of cash makes cash available to meet the outflow obligations of firm. Secondly, meet the obligation cash flow. Efficient cash flow management can manage cash flow properly and avoid such adverse conditions. Third, planning capital expenditure projects. Efficient cash flow management assists in planning capital expenditure projects and ensure the cash flow for their surplus implementations. Fourth, favorable external financing. Efficient cash management helps to maintain the liquidity and keeps up the goodwill of a firm. Fifth, advantage of business opportunities. The proper cash management assists the firm to take advantage of discounts, special purchase, and business opportunities. And lastly, investment of surplus cash. Obviously, cash management helps to CFO to invest idle cash, keeping the future cash flow stream and liquidity positions of the firm. For the practice, I have taken the cash budget problem here. In the first column, it says month, and second column sales, third column purchase, fourth column wage, and sixth column overhead. And there is additional information given. There is 9 additional information that we need to consider while preparing the cash budget. So in the exam, you will be given the question like this, and you can solve as follows. We write here cash budget, cash received. So under cash received, we will do month. If you look, the requirement here, it is asking prepare cash budget for April, May, and June. We are given here the information from March to June, but in question it is only asking to prepare cash budget from April to May. So it is it's only 3 months. So in the April, May, and June. So how do you collect the money for the company? It is from the sales. So company sells the company sell product and service, and they get the money. So in this cash budget, in the information number 2, it is saying half of the sale is cash sale and other half is collected next month. So let's start from here. Total sale for the April, it is 80,000. For the May, it is 84, and June it is 76,000. So cash sale, we know that 50%. So that means out of 80,000, 50% is 40,000. 40,000 is cash sale. Cash sales means we get the money the month we sell the product. So 84,000, we get 42,000, and 76 is obviously 38,000. 38,000. And credit sale, that we get calculated from 50%. Out of the 80,000, it will be collected next month. So 40,000 will be for the April. 50,000 will be collected in May. So 50,000 is 40,000, and 50,000 for June is coming from the May. So for the April, we'll have to have a look for the March. So March, the 50% of March is collected in next month of April. So total value is 64,000. So what is the 50% of this? So 32,000. 32,000 is coming from March. If you look in the number 3, it is saying share call money of 25,000 is due on 1st of April. So we are getting 25,000 in the month of April and June. Share call. What is saying it is here and the questions? It is saying in the April and June, how much? We are getting $25,000. In June is 25,000. So total cash collection let's add up all of this. 97,000, 82,000, and this one you will get 105,000. This is our cash collection. And the next bit we have to have a look the cash payment. For the cash payment we are given here the expenses. Expenses is purchase, wage and overhead. In the number 5th, wage are to be paid during the month of occur. So that means a wage is paid as soon as the expenses occur. And for the purchase and overhead are to be paid during the month following the month of supply. We will get here purchase from previous month. What does that means? A purchase for the April, that April money will be paid in May. So what is the amount here? It is 56,000. So April amount would be paid in May. So 56,000 is paid in May. So for the June, we have to have a look the May one, because May money is paid in June. So 62,000. And for the April, we will have a look. We have to have a look for March, because March money is paid next month. So that means 50,000 is paid in April. This is how overhead from previous month. It is same detail for overhead as well. So we have to have a look the overhead section here. The overhead is paid the next month, the month occurred. So that means for the April, we can have a look the March one. So March is 68,000 that will be paid in April. So 68,000, 6,800, and for the April it will be paid in May. So 17,200, and for the May it will be paid in June. So which is 8,000. And for the wage, like I said before, wages are to be paid during the month of occur. So that means wages is straightforward. We can simply write down or copy this and paste over here, because the money is paid for the duration of the same month. So that is 12,400. For the May it is 13,000, and for the June it is 14,000. Pretty simple. And for the number 6, it is saying 5% sales commission is to be paid within the month following actual sales. So sales commission %5 of previous month. So this is expenses, but these expenses will be coming from previous month. So what does that means? For the April, the commission will be paid from the sales of March. So what is the sales figure for March? It is 64,000. So 5% of these commissions will be paid in April, 3,200. And for the May, you will have to look the April one, the 5% of 4,000. And for the June, you will have to look the May figure. The May figure is 84,200. Number 7, preferred dividend is to be paid on 1st of May. So there is preferred dividend paid, which is only paid in May. So preferred dividend payment, which is paid in May. So April is nothing. How much is the amount? It is 40,000. Nothing in. Plant and machinery was installed on January and payment is to be made on June. Plant and machinery installation, $10,000. Payment, total payment, simply add all of this, 72,400, 130,000 and 200, 98,800. We get here, we need to find out the beginning balance. First point, it says expected cash balance on 1st April is 20,000. So in 1st April, it is expected that 20,000. We have to find out the total cash balance. How do we find the total cash balance? Add total cash collections. That means total cash collection is 97,000. So simply total cash balance is 117. We deduct the figure here. Total cash payment. The total cash payment is 72,400. Let's simply deduct 117 and 117 minus 72,000. We get 44,600. $44,600 surplus amount is 44,600. We have a look here. Borrowing, we didn't have to do anything. Borrowing, ending cash balance, which is 44,600 for the month of April. So for the May, the ending balance of April will be the opening balance of May. So simply copy this amount over here, 44,600. Total cash collection for the month of May is 82,000. Let's add all of this. 44,600 plus 82,000. How much we get? 126,600. And we deduct the total cash payment. Total cash payment, how much we paid? We paid 130 and 200. The total payment is greater than total receipt. So that means we have a deficit here by how much? 130.2 by 3,600. We are deficit So this is a quite problem here. So we need to maintain, as a question, it says that minimum cash balance is to be maintained 5,000 each month. But we are already here, 3,600 is short. So that means our minimum standard is not met. So if we borrow 8,600 pound, then we will be able to maintain that 5,000, because 8,600 minus 3,600 is 5,000 pound. That means the ending balance we get here is 5,000. Closing balance of May would be the opening balance of June. So 5,000 will be transferred over there. Again, let's add this 105,000 cash collection. How much we get? 110,000. So again, let's deduct the total cash payment. The total cash payment is, we know that 98,800. This is good news. The cash payment is less than cash received, so that means there is no deficit. So how much we get? 110 minus 98,800. There is a surplus of 11,200. Good news. How much we borrowed earlier? In the month of May, we borrowed 8,600, but also we need to maintain the minimum cash balance of 5,000. That is required by the information that we need to minimum cash balance is to be maintained. So what we do is we just maintain $5,000 here, then we'll only pay the remaining amount, 6,200 of money to pay out of this debt.